Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you here as we head deep into February and cover this week's Market Carver. We got a couple of topics to go over this week, not in the slides just because it's not that big of news. I think we kind of laid the groundwork, but the Federal Reserve did have their meeting. You might have even heard Powell during a 60 Minutes interview, but the work over the past week has been from the Federal Reserve to push back. The market had been aggressively looking for interest rate cuts, and they pushed back on that. The Fed likes to have some options on the table. So when the market got too excited or too hopped up for an interest rate cut, they just wanted to pump the brakes on that. So we've seen bond markets and others adjust to that reality. And of course, we'll be monitoring the data. A couple of big inflation reports between now and then will likely determine what moves they make. So that's beyond the slides that we do have. We'll talk about volatility and a bigger picture and what to expect in any given year. And then Andrew will update us on the near-term market outlook and where we are after what has been a good few months. So we'll dive right in and start talking about the volatility. And this is a nice chart from JP Morgan. We've probably shared it in the past, but it's just worthy of revisiting. You see the updated version for 2023. The first thing to notice is that for the overall U.S. stock market, positive returns are the norm. Of course, you're aware of that, but it's 33 out of 44 years. So overwhelmingly, the moves are up. But also notice what else is overwhelmingly ordinary, and that is intra-year declines. So even in up years, it is to be expected that we have on average, a 14.2% decline. So here at Financial Enhancement Group, we believe it's very important not to have more money exposed over the near term than what your plan, your situation, your tolerance can take. If you're invested into stocks, this near-term volatility is to be expected. Of course, it's a sexier way to think about trying to bob out and get out of the market to avoid these. And of course, we do have a risk barometer, and we do employ risk management tools to keep them muted. But it's much healthier to start with the reality that this is the norm. Double-digit declines are a part of most years. So I think that's just a good reminder that we got from JP Morgan. Andrew, I'll pass it over to you to take an updated look at the near-term market.
Thanks, Adam. What Adam was talking about fits very much into with the chart that I was going to bring and share discussing the price action that we're seeing in the market today. So to echo what Adam was talking about, that some degree of volatility is normal. We can't expect the market just to go straight up without any type of maybe small pullbacks. And that's fairly average each year we see in the stock market. We're at a place now where we possibly may see some of those minor, potentially declines in the stock market just because of the strength that we've experienced over the last several weeks, several months has been so strong. The proverbial rubber band of the market has gotten a little bit stretched. We typically like to see really strong momentum on the way up. The price action is very good. Prices are moving higher. We're encouraged by that as much as you are, I'm sure. But it does get to the point where we can get a little bit too far extended over our skis, so to speak, to use one analogy. And the way we can represent that is looking at how far the S&P 500, a very common popular index, how far is it trading above its average price over the last 200 days? A very typical moving average smoothing mechanism for the market. And we can see over the last 200 days, here's what the average price is. Here's where we are today. How far are we between those 2 points in time? And that's what this chart is looking at. Currently, we're just about 12%, 11.7% above that long-term average. Why that level is significant is that typically when we get to about 12%, a little bit more of an art than a science here, is that's where we start seeing the market get a little bit extended. We've seen this happen several times. Actually, it happened last year. Last summer, around July and August, we saw this very same type of instance where the market had been really, really strong, got a little overextended, and when we saw a resulting 10% pullback, that traders came in, bought, and sent the market higher into year end. Before that, we saw it in 2018. The market was very strong in 2017, very strong in January of 2018, got a little bit over our skis, to use the analogy once again, and then we saw a 10% pullback. And I've marked in blue circles each time this has happened. The few times where the market's kind of ignored this environment has been when we've come out of very large bear markets. Think the tech wreck back in the early 2000s, the financial crisis in 2008, COVID crash in 2020. When we see the market have these really strong rebounds, it's typical for us to see really strong price action, rises really quickly. We get overextended like we are today, and the market just keeps going because the market is experiencing a very bullish type of environment. Unfortunately, that's not what we're seeing today. We're not, thankfully, just coming out of a major bear market. In fact, we're seeing the market's been hitting recently new 52-week highs. So with this said, typically we would see roughly 5-10% would not be unusual. As Adam just shared, on average, we see a 14% drawdown each year. That's typically what the market shows us each year. So seeing some type of pullback, let the market digest these gains, kind of decline a little bit, and that may set up for continued strength in the year end. Of course, we don't know what to expect going forward, but we want to watch it day by day and evaluate the risk of the market, look for good opportunities. And because of the strength we've experienced so far, we're at a point now where maybe the market needs to cool off a little bit and experience kind of what Adam was just describing. So again, that's kind of the thesis or the hypothesis. Then we're going to look for and see if the market begins to confirm it, and if we start seeing price action begin to wade lower a little bit in the near term. But again, this is looking at days and weeks. Of many people's time frames is months and years. And so we're always trying to balance different time frames and levels of importance as we're evaluating actions and evaluating the risk and opportunities within the market.
Excellent, as always, Andrew. And I thought it would be helpful, just as I was listening. We'll spend a couple minutes, I think, tactically speaking about our portfolios, because I think what that shows is Andrew, for those of you that don't know, is one of our portfolio managers, and he's very instrumental in how we use the risk barometer and adjust portfolios. And Andrew, what we've seen as of late is that we've got to move into offense. The market's been in a nice, solid uptrend. And so just want to paint the picture here that nothing changes in regards to that risk barometer. But where Andrew has things right now is, say, we're going on offense, we're pushing the gas a little bit, but we don't have it pushed all the way to the floorboard. So maybe what we have here is an opportunity, whether we do get this 5 or 10%, maybe it is a chance to put on the gas just a little bit more. So unless you have anything else to add, Andrew, I was just going to.
No, I think that's well put.
2 cents in. Yeah. Very good. And I don't ski, so I'm not coordinated enough. I would definitely be out of my skis and tumbling down the mountain. So I'll stick with the automobile analogy. So I thank you all for your time. As always, I give you a reminder to give us a buzz if we can be of service, 800-928-4001, or scan the QR code and book it electronically. So thanks again and have a great weekend.